Welcome back to EDS, and in this video I'm going to show you how you can grow a small account, a small portfolio by writing options contracts and collecting a premium upfront. So the first thing you want to do is just open any equities underlying. You've got Apple open at the moment. You can use anything that you like, and you want to navigate over to the list of expiration dates. Now, all expiration dates are the same for equities. This is why it doesn't matter which one you pick. We just want to choose an expiration date that we can use moving forwards. So the one that we want to go with needs to be between 30 and 60 days out in time. It also needs to be a monthly, not a weekly or quarterly expiration date. Now, the only expiration date that fits that criteria right now is February 21st, with 50 days left on the contract. So what we want to do is take that information, come over to our watch list, and simply filter out any and all underlyings that have an earnings event within the next 50 days. Now, we are writing these contracts and selling them, shorting them. So we want to sell high, buy low, and the higher the volatility or implied volatility, the higher the options price. So if we're in a position and we have an earnings announcement coming up, that will increase volatility, which will increase the price of the option, which will be bad for our P&L. So we want to avoid that. This is why we filter out anything with earnings, and we also want to filter out anything with a low liquidity rating level. This is simply because we want to only trade liquid markets with tight spreads so that we can keep as much of our profit as possible. Now, at this point, I personally like to order everything from high to low in terms of IV rank. And you want to go down the list and see what would fit well in your portfolio. Keep things nice and diverse. Keep in mind the size of the underlying in relation to your portfolio. However, that's not to say if you have a small portfolio, it doesn't mean that you can't trade larger underlyings. I'm going to show you how you can manipulate positions to fit any position inside of your portfolio. So we just go down the list, and the first thing that comes to mind is GLD with an IV rank of 48.4. If we go a little bit further, we've got TLT with an IV rank of 42. We've got AVGO with an IV rank of 38.7. Any of these would probably be good underlyings to look for a position on. Let's just go with AVGO. We've not looked at AVGO in a little while. It's trading at just over $238 a share. We've got an IV rank of 38.7 and an absolute IV level of 43.6. So if we come over to the list of expiration dates for AVGO, we're going to select February 21st, which is the one that we chose at the beginning of the video. And we are now presented with the options chain. Going across the middle is this orange horizontal bar that shows us where the price of AVGO currently is with respect to the strikes, and we've also got a vertical orange bar that shows us what the expected move of AVGO is over the next 50 days. Now we want to create a position that is going to give us a high probability of success, and we will be writing these contracts, which means that we don't want price to go near them. We want price to stay away from our contracts. We don't want price to go beyond or breach our contracts. So what we're going to do is we're going to sell some contracts, and we're going to sell them outside of the expected move. So what you'll notice is outside the expected move is we have these dotted blue lines, which are our standard deviation levels. So generally speaking, if we go with something between a 15 and 20 delta, we will typically end up outside of the expected move and around the one standard deviation mark. And that's a little check that you can use to make sure that you're marking up positions correctly. So we've got a 19 delta here at the 275 strike, and we have a 19 delta at the 210 strike, making us which gives us a pretty much almost delta neutral position. And what we've done is we've created a range for ourselves, and as long as price stays within this range between 210 and 275 at expiration, we will keep all of the premium that we collect up front. Now, if we look in the bottom left corner, we have our POP, which is probability of profit. and it's sitting at 70%, which means there's a 70% chance of making at least 1 penny on this position at the point of expiration. And if we want to get out of this position early and not wait till expiration, we have a 86% chance of making 50% max profit at some point over the next 50 days. So we're looking at probabilities between 70 and about 85-86% success. So very, very high probabilities of success here. And how much money do we actually make on this position? Well, if we look in the bottom middle, we have our premium that we will collect, which is $7.50. There is a contract multiplier on equities of 100, so you would multiply this out by 100. So we would get a max profit of $744. The market's live right now, so anywhere around between 740 and 760. We probably get filled at about 745. But generally speaking, about $750 is what we'll collect up front. And our broker is going to require a little over $7,000 to open this position. So we're getting a return on capital of above 10%, which is very nice for a naked position. However, $7,000 is probably too much for most people to have tied up on any one position. So what we can do to manipulate this position to fit inside your portfolio is simply use some of this premium that we're going to collect up front to buy some contracts to cover our shorts. So if we just go one strike further out, we can buy the 280 on the call side, and on the put side we can buy the 205, which is going to cost us in premium. So we collect less premium up front, but what we've done now is we've defined our risk, which is defined by the spread in between the two contracts, which is $5 minus the premium up front, multiplied out by the contract multiplier, which gives us our max loss of $345. Our broker knows this, so that's what's required in buying power. And as you'll notice, our buying power requirement is now $345 instead of $7,000. So what you'll also notice is we're going to collect $155 up front, and our broker is going to require $345 in buying power. So we have a much higher return on capital this way. In exchange for the higher return on capital, we do have slightly lower probabilities of success, and that is simply just the trade-off of this position. Nothing is for free in the market, but that's how you can find and manipulate positions to fit inside your portfolio. If you want to know how much buying power you should be allocating to your positions, then click the link in the description, click on the free position sizing template, and it will take you to this spreadsheet. The way it works is you enter in the size of your portfolio, and then you enter in the current VIX level, and everything below will then be automatically calculated for you. All you need to do is use this information to form the backbone of your portfolio. It will tell you the maximum amount of buying power to allocate to any single defined risk position, undefined risk position, and how much of your portfolio you should allocate to short premium strategies in general. And as long as you follow this blueprint over the long run, you will be absolutely fine. If you would like to learn in more detail about what we do and how we do it, again, link will be in the description. This time click on EDS Premium, get yourself signed up. Inside you'll have access to our portfolios that will allow you to see the positions that we're placing, how we're managing risk, the adjustments that we're making, all in real time. There is also a full course, so no prior knowledge is required. We will teach you everything that you need to know from start to finish, and it is a private community, so if you get stuck at any point, you can speak to myself directly or with other like-minded individuals, and we'll all be there to help you. There is also a 100% money-back guarantee, so once you have studied our full course and followed our trades for at least 6 months, if at that point you aren't profitable, we will work with you for free until you are, or you can simply request a full refund. So it's completely risk-free. It's £1 a month to join right now. The price will be increasing. We've just launched, that's why it's so cheap. However, once you're in, the price is locked in for you for life. And the aim of EDS Premium is to get you to a point where you know what to do, and you've learned the skill and you know what to do, how to do it without any external help or influence within 6 to 12 months. You are always welcome to stay and be a part of the community, but 6 to 12 months is as long as it should take, and then you'll be good to go for the rest of your life. So with that being said, I will see you guys on the inside.